Have you ever worked really hard on a plan, thought you had every angle covered, felt totally sure about how it would turn out, and then, well, just one small, unpredictable thing happens and kind of unravels the whole deal?
It's incredibly frustrating, isn't it? And in finance, especially when you're talking about hedging strategies, that's not just, a possibility. It's almost a given sometimes.
Yeah, you build these complex defenses against market movements, but you're often working on assumptions. Assumptions the real world doesn't always respect.
Exactly. And that subtle thing, the disruptor that often goes unseen, that's what we're really digging into today. It's a concept called basis risk.
Basis risk.
Yeah, it's one of those, let's say, financial nuances that can quietly but really powerfully just undermine even the best laid hedging plans.
So our mission for this deep dive is to unpack a real world scenario. We've got a case study that really shines a light on how maybe a tiny deviation from what you expect can completely flip your preferred strategy on its head.
It should give us some real aha moments about this often overlooked idea. So let's start right at the beginning. What even is basis?
Right, the foundation.
And simply put, basis is just the difference between the futures price of an asset and its spot price.
Okay, so the price for delivery later versus the price right now.
Precisely. Like if oil for delivery next month cost $80 a barrel, that's the futures price, but you could buy it today for $78, the spot price.
Yeah.
That $2 difference.
That's the basis.
That's your basis. Exactly.
And, in a lot of the models, the theory behind planning, there's this, quite elegant assumption, isn't there, that the basis just shrinks.
Yeah, it's assumed to diminish at a constant predictable rate, like it's ticking down towards zero as the contract gets closer to expiring.
Very neat. Makes the calculations work out nicely.
It does. But basis risk, this is the critical point.
Yeah.
Basis risk happens when that predictable relationship just breaks down. It's when the futures price doesn't move in lockstep with the spot price you're trying to hedge. It sort of goes off on its own path.
And when that unpredictability creeps in.
That's when the hedging tools that look like the obvious best choice might suddenly, not perform as well as the alternatives.
Okay, let's make this concrete. You mentioned a case study, Wardegul Co.
Yes, Wardegul Co. Let's put ourselves in their treasury department.
Yeah.
The date is October 1st, 2017.
Right.
They know they're getting a big receipt, D27 million in Urian dinar on January 31st, 2018, and they need to invest that cash until June 30th, 2018, so about 5 months.
Okay, a 5-month investment window. What were the market conditions like then?
Interesting times. The central bank base rate in Urea was 4.2%. Wardegul expected they could invest their money at 30 basis points below that.
Yeah.
3.9%.
But there was uncertainty.
A fair bit, yeah. Predictions were all over the place. The base rate could potentially jump by 1.1%, hitting 5.3%.
Wow, quite a hike.
Or, surprisingly, it could fall by 0.6%, down to 3.6%. So big potential swings either way.
Facing that kind of uncertainty, what hedging tools were they looking at?
Two main options were on the table: interest rate futures and then exchange-traded options on those futures.
Got it.
We're talking specifically about 3-month dinar futures. Each contract covers D500,000. And they're quoted in a slightly counterintuitive way.
How so?
The quote is 100 minus the annual percentage yield. So a higher quote actually means a lower interest rate.
Okay, so if the yield is, say, 5%, the quote is 95.
Exactly. And the March 2018 futures contract they were looking at was quoted at 94.78. They also had options available, but strike prices like 94.25 and 95.25.
Right. So let's walk through their thinking, but first, let's stick with that ideal world scenario, the one where we pretend basis risk isn't a thing.
Okay, no basis risk world. To hedge against rates potentially falling, they look at buying March futures contracts.
Because buying futures locks in a rate, essentially, or protects against a fall.
Right. And to cover the D27 million for the 5-month period using 3-month contracts, they'd need, 90 contracts.
90 contracts, okay.
And in this perfect world, they'd calculate the initial basis, the difference between the implied futures rate and the current spot rate.
And then they'd assume that basis shrinks predictably until January 31st.
Correct. They figure out how much of that basis should still be remaining when they close out the hedge. Let's call that the unexpired basis.
So what did the outcome look like under this perfect plan? Let's say rates did go up to 5.3%.
Okay, if the base rate jumped to 5.3%, their direct investment return would be pretty good, D562,500. But because they bought futures expecting rates might fall, the futures price would drop, creating a loss on the futures position.
Okay, so the gain on investment is offset somewhat by the futures loss.
Exactly. But when they netted it all out, The projection showed a net receipt of D515,250. That works out to an effective annual interest rate of 4.58%.
4.58%. Okay, but what if rates went the other way? What if they fell to 3.6%?
Right. This is the theoretical beauty of futures. If rates fell to 3.6%, their direct investment return would be much lower, only D371,250. But because they bought futures and rates fell, the futures price would rise. They'd make a profit on the futures market.
Okay, so the lower investment return is boosted by the futures gain.
Precisely. And when they netted that scenario out, the net receipt was still projected to be D515,250.
The exact same number.
The exact same number, meaning the effective annual rate was still 4.58%.
Wow. So theoretically, futures offered this perfectly locked-in rate of 4.58% no matter what the central bank did with the base rate.
That's the textbook promise.
Yeah.
And you can see why that predictability would look incredibly attractive to a corporate treasurer, right?
Absolutely. Rock solid outcome. But what about the options? How did they compare in this no basis risk world?
Okay, options. They look at buying March call options, again for 90 contracts. Let's compare the two strike prices, 94.25 and 95.25.
Yeah.
If rates rose to 5.3%, remember the futures price is expected to be 94.36 in this scenario. The 94.25 call option would be exercised because 94.36 is above 94.25. But after accounting for the premium paid, the net result gave an effective rate of about 4.56%.
Slightly lower than the futures 4.58%.
Slightly, but the 95.25 call option wouldn't be exercised. 94.36 is below 95.25. So they just lose the premium, but benefit fully from the higher investment rate. That gave them a net effective rate of 4.90%.
Oh, significantly better if rates go up.
If rates go up, yes. But what if rates fell to 3.6%? Now the expected futures price is much higher, 96.06.
Yep.
Both call options would be exercised. The 94.25 strike still gives that same effective rate, around 4.56%. Consistent, but still just under the futures. However, the 95.25 strike, while exercised, gives a much lower outcome because the strike is so high relative to the original rate. Its effective rate drops way down to 4.01%.
Yikes. Okay, so summing up the no basis risk view, futures give a guaranteed 4.58%. The 95.25 option is great if rates rise, terrible if they fall. The 94.25 option is okay either way, but always just a tiny bit worse than futures.
Exactly. So if the board is risk averse, that fixed 4.58% from the futures looks like the winner based on these assumptions.
And it's a big but. We've been living in theory land. Here comes the twist, right? What happens when basis risk, that real-world unpredictability, enters the picture?
This is where it gets really interesting. Let's fast forward. It's now January 31st. And guess what? The central bank base rate did increase, exactly as one scenario predicted, to 5.3%.
Okay, so the rate prediction was spot on.
Spot on. Now, according to that constant basis assumption we used earlier, the March futures contract price should have closed at 94.36. That was our calculation.
Right, based on the 5.3% rate and the assumed remaining basis.
But the market had other ideas. The actual closing price for the March futures on that day, it was 94.16.
94.16? Wait, that's only 0.20 lower than predicted, 20 basis points? I mean, is that really a big deal?
You'd think it wouldn't be, wouldn't you? But watch how this seemingly tiny shift completely changes the outcome for Wardegul Co. Let's recalculate with this actual futures price.
Okay, hit me. What happens to the futures hedge now with the actual price of 94.16?
Well, the direct investment return is unchanged. Rates went to 5.3%, so they still get their D562,500 from investing the cash.
Makes sense.
But the loss on the futures market is now based on closing at 94.16, not the expected 94.36. Since 94.16 is lower than 94.78, the price they bought at, there's still a loss, but it's actually a bigger loss than anticipated.
Bigger loss? How does that work? Oh, wait, the closing price is lower than the expected closing price.
Lower than expected and lower than the purchase price. Calculating that loss based on 94.16, it comes out to D69,750.
Okay, so the new net receipt is?
D562,500 minus D69,750 gives you D492,750.
D492,750, and that guaranteed effective rate of 4.58%.
On the actual effective annual interest rate they achieve, it drops to 4.38%.
4.38%, so that tiny 0.20 difference in the futures price wiped out a significant chunk of the expected return. That is a big deal.
It really is. Now, what about the options? How do they look now, given the actual futures price closed at 94.16?
Good question. Does it change whether they get exercised?
It does. Remember, the strike prices were 94.25 and 95.25. since the actual futures price is 94.16.
Ah, it's below both strike prices, so neither option is exercised.
Exactly. So for both options, Wardegul just loses the premium they paid initially, but gets the full benefit of the higher investment return since rates went up to 5.3%.
Okay, so let's see the numbers. The 94.25 option first.
For the 94.25 option, the net receipt works out to the D501,087. That translates to an effective rate of 4.45%.
4.45%.
Yeah.
Interesting. And the 95.25 option.
Same logic, not exercised, just lose the premium. The net receipt is D551,475, giving an effective rate of 4.90%.
And Whittier, let's pause and compare these actual outcomes now with basis risk included.
Yep.
Futures gave 4.38%. The 94.25 option gave 4.90%.
That's right.
This completely flips the script. The futures hedge, the one that looked so safe and reliable in theory,
It actually delivered the lowest return of the three.
lower than both option contracts. Even the 94.25 option, which looked marginally worse than futures before, now looks better.
And this happened even though the underlying interest rate moved exactly as predicted in one of the scenarios. It wasn't the rate forecast that was wrong. It was the assumption about how the futures price would behave relative to that rate.
So it was that small, unpredicted deviation in the futures price closing at 94.16 instead of the calculated 94.36 that made all the difference.
That's the heart of basis risk. When that relationship between the futures price and the spot price, or the underlying rate in this case, isn't perfectly predictable, your hedge might not behave as expected.
The calculations rely on that predictability.
They do. And when it breaks down, even slightly, the outcome can shift significantly. The futures hedge failed to lock in the rate precisely because the basis didn't move as assumed.
It introduces this layer of uncertainty you can't easily model away.
Exactly. And looking back now with perfect hindsight, Wardegul would have been much better off with the 95.25 option, or even the 94.25 option in this specific outcome.
But hindsight is 2020, isn't it? When they were setting up the hedge back in October.
They didn't know the futures price would end up at 94.16. They had to make a decision based on the information and models available then. And those models often rely on simplifying assumptions, like basis shrinking constantly.
Which, as this case clearly shows, doesn't always happen in the real world.
It really underscores why financial teams need to be aware of basis risk right from the start. It's not just some academic concept. It has real financial consequences.
And it suggests that maybe relying solely on one expected outcome isn't enough. That scenario analysis you mentioned
Becomes crucial. You need to look at how different strategies perform under various conditions, including conditions where basis might not behave perfectly, to make sure the final choice truly aligns with how much risk the company is willing to take.
So wrapping this up, the big takeaway seems to be that even tiny, unexpected changes in how financial instruments relate to each other, that basis relationship can seriously impact hedging effectiveness.
It fundamentally challenges that idea of achieving a perfectly fixed, guaranteed outcome through hedging, especially with futures when basis risk is present. The theory is neat, but reality can be messy.
And thinking beyond finance, this idea probably resonates, doesn't it? Think about your own plans, maybe projects at work, or even personal goals. What are the simplifying assumptions you might be making?
That's a great point. What relationships are you assuming will remain stable? How might a small, unpredicted shift in one of those background factors potentially change your expected outcome?
It prompts you to think. What kind of scenario analysis could you do in your own life? How could you build in a bit more resilience to account for the fact that things don't always go exactly according to the neatest plan?
Something definitely worth pondering. That inherent unpredictability, even in seemingly stable systems.